Well, hello everyone, and welcome to the Alamo Mortgage Holdings webinar. In this webinar, we're going to talk about how you can earn potentially a significant and growing long-term passive income when you make the wise decision to purchase one of our corporate income bonds that are backed by U.S. mortgage debt. But before I do that, I'm going to go through a disclaimer. As accredited investors, you will be aware that all investments carry some level of risk. This investment is only available to investors who are able to assess their own appetite for risk. Please read the risk statement within the investment memorandum before investing. All right, so our financial product pays 8% paid biannually. We offer a term of 3 years, 5 years, all the way up to 50 years when you purchase one of our bonds. The team that is behind Alamo Mortgage has 200 years of business experience with 100 years in the mortgage and the real estate industry in Texas. We sell a bond that pays hundreds of basis points more than UK gilts or other government bonds. And we invest into purchasing packages of mortgage notes. This lets us earn a significant amount of money, far above 8%, and that allows us to pay the bondholders such a great rate of return. We sell the bond in British pound sterling, US dollar, or euro, so you can take your pick. And once again, the terms are 3 years, 5 years, and 50 years. The 2023 series, all of the series pay 8%. So why do so many UK investors still purchase gilts for passive income? Mostly it's because they're looking for security. But if you look at the history of the US dollar and the British pound, even though those investors purchasing gilts may have security, they also are exposed to an exchange rate that has a long history of the British pound losing value against the US dollar. If you went to the start of the Bretton Woods Agreement back in December of 1945, one British pound would buy 4 American dollars. And as the decades have passed, the British pound has lost value, so that as of the 1st of January 2023, one British pound, instead of buying 4 American dollars, it only bought $1.21. So that is something that's real relevant in terms of the actual real rate of return, because if all of your investments are in British pounds, you are exposed to the exchange rate movement of the British pound relative to the US dollar. So how can we pay 8%? That's a question that we are sometimes asked. It's fairly simple. We go and we purchase the debt at a discount where we are able to get a yield that is much higher than 10%. For example, if we have a 100,000 mortgage that has an interest rate of 10%, and we purchase that mortgage for 70,000, the yield on that mortgage increases to 14.2%. And that makes it easy for us to pay out 8%. And for those of you who may not remember, the yield is just the annual cash flow divided by the price you bought the asset at. Okay, so what determines the value of a mortgage note? This is important. Sometimes people see this and they think, you know, that's a great idea. I'm going to buy mortgage notes. Well, if that's it, that is a good idea to buy mortgage notes. But if you're going to buy mortgage notes directly, you should know what drives the value of a mortgage note. Well, the first thing that determines the value of a mortgage note is the actual buyer. Who is the one that's guaranteeing the mortgage debt? Maybe if they have a job as, say, a government employee and they bought a property, they are more desirable as a buyer compared to somebody that has a startup company that may not be receiving regular income with which to pay the mortgage. The second thing is the actual collateral that backs the mortgage note. Let's imagine that the asset is worth 100,000 and there's a mortgage note that was created for 200,000. Imagine a situation where maybe some buyer from another state like California came to Texas, didn't know what the prices were in Texas, and met a seller that was a real good salesman. And the salesman seller managed to get them to agree to pay $200,000, even though the asset's only worth $100,000. Well, the fact that there's a mortgage note for $200,000 does not make that asset worth $200,000, and it doesn't make that note worth $200,000. You have to look at the actual value of the property in all cases. Another factor that drives value is the down payment. In general, if a buyer puts a larger percentage down, maybe they put 20%, that is better than a buyer that only put 5% down, because the buyer has more to lose if they walk away from the deal. Other factors being equal, the interest rate's important. You would prefer to purchase a 10% mortgage note compared to a 5% mortgage note. What about the history of payments? Were the payments serviced by a company? Is there a company that did mortgage servicing, an independent company that's reporting when the payments were received? Or are you receiving from the seller a spreadsheet and the seller telling you, yeah, he always pays on time, he's a good borrower? The paperwork, was it something that closed at a title company? Was the paperwork done correctly with lawyers, with attorneys? The pay history, all of these things are important in determining the value. Now let's take an example transaction to make it more clear. This is a real property. It's not one that's in our portfolio, but it's shown for the purposes of illustrating this. Let's imagine the seller is asking $120,000, and the seller finds a buyer that says, okay, I'll pay $120,000, but I want to put $20,000 down. And the seller says, listen, I need you to go get a bank loan. I'm not going to be your bank. Go talk to my friend. He's a banker. So the buyer goes and talks to the friend who's a banker, and the banker says, listen, you're self-employed and you have bad credit. I'm not going to give you a loan. Get out of my office. So the buyer goes back to the seller and says, I could not get a mortgage, but I have $20,000. I'll pay you $20,000. Let me make payments to you. So the buyer and seller, they agree that a 10% interest rate is reasonable. The seller says, I'm not going to finance it to you at a low interest rate. They work out a loan scenario where every month, this is a monthly payment of $877.57. Now imagine 5 years have passed, 60 months have passed, and this buyer has been making the payments on time. They've been doing such a good job as a buyer. So the unpaid balance on that note is $96,574.32. And imagine that the owner of that mortgage note, the former owner of the property that's holding the note, they wake up and they need cash, or they want cash one day. So the first thing they do is they call their buyer and they say, hey, it's been 5 years. Can you go get a mortgage loan so you can pay me off? And the buyer says, no, I still have bad credit and I'm still self-employed. So at that point, the owner of the mortgage note starts searching on the internet and types in sell a mortgage note for cash. And they find a company like Alamo Mortgage Holdings, and they call the company and they say, I've got a great mortgage note. Will you buy it for $96,574.32? And that is where the game begins, where the negotiations back and forth. And let's imagine that the discount offered is, if you want cash, we'll pay you $83,322.39. That is a 12% yield. That is how that works. So what are these mortgage notes? What does this mean, packages?
Is actually an example of what a portfolio of loan notes might look like. So this is actually a real portfolio. And you look here and you can see the name of the borrower, the number of months. You can see the interest rate. This debt is actually pretty high, 14.75% is what they're paying on that mortgage. The monthly payment is $278.50. Then you can see the terms, the status, this sort of thing. So, I mean, you've got a list here, and this is an example of a package where a package of these mortgages can be purchased. This type of deal would be done by a larger investor. It would not typically be a single investor that would buy this package. For example, My company, Alamo Mortgage Holdings, this is the type of package that we might actually purchase, something like this. But if you're just starting out in investing, you might start out by, you're just going to buy one mortgage note. So for example, you might come in and this mortgage note, if you find something like this out on the market, you might try to negotiate down from, the unpaid balance at 89,570. Maybe you try to buy it for 59,000 or 69,000. But that would be one note. But you can also purchase packages of notes. And that's something that Alamo Mortgage Holdings is involved with. It's a company that's a United Kingdom company that actually purchases packages of mortgage notes.
So that's how that works. That's what a package of mortgage notes looks like. Sometimes I'm asked by people, well, why would I buy bonds? I mean, inflation is high. I'm not stupid. Why would I buy bonds? Well, good question. Rather than me giving my opinion, rather than me telling you Benjamin Z. Miller's opinion, I'm going to talk about a Nobel Prize winning economist named Harry Markowitz. And if any of you have accounts at Merrill Lynch or BlackRock or Bank of America or any of the big banks, they just love Harry Markowitz's work, and they use it in a lot of their portfolio design that their geniuses and their experts use. Harry Markowitz, he won the 1990 Nobel Prize for modern portfolio theory, and he created this body of work that's used in portfolio allocation, and the banks and the investment firms, they just love it. However, the interesting thing about it is, even though Harry Markowitz created all of this, when it came to his own personal portfolio, he didn't even use it. Instead, he used a much simpler thing where he would put 50% of his portfolio in bonds and he would put 50% in stocks. And then once a year, he would make an adjustment. If the stocks went up a great deal in value, he would sell stocks and he would buy bonds. Or if the stocks went down a great deal in value, he would sell bonds and he would buy stocks. So as a result of that, that's how he actually balanced his own portfolio. Okay, so why Texas? Well, that's a great question. Okay, Texas is a state that is winning. We have people moving in from California and New York because they are tired of the job-killing legislation in those states. They are tired of all of the overregulation. They're tired of the outrageous real estate prices. And they move to Texas and they think they are in paradise because instead of a house costing $1 million, a house only costs maybe $200,000 or $100,000. So they just love Texas. But all of these people moving into the state of Texas has the effect of increasing the demand. It shifts the demand curve for Texas real estate, making Texas real estate more valuable. And that is a great thing for Alamo Mortgage Holdings because the collateral that backs our debt is Texas real estate. So that is why Texas. And for us, the team that we have in place, we have 100 years of experience in Texas alone in the mortgage and the real estate industry, 200 total years of business experience. But by us focusing on just one state, it makes the business easier to win compared to trying to do all of the other states where the rules can be slightly different. Okay, so what are the key features of the bond? First, you can reach your passive income goals far more quickly. We also offer maximum diversification. Instead of just buying one mortgage note, you are able to benefit from the fact that we purchase packages of mortgage notes, where if one mortgage doesn't pay, it's not the end of the world. We don't charge our investors any fees. I hear sometimes from people who brag about their low-cost index fund, and they are so proud of how low-cost their index fund is. Well, folks, would you rather just pay 0%? Because if you make the wise decision to invest with Alamo Mortgage Holdings bonds, you pay 0%. How does it work? You put 100,000 pounds in, every year you're going to earn 8,000 pounds in interest. In 5 years, you're going to earn 40,000 pounds. In 50 years, you're going to earn 400,000 pounds. You pick the term, we pay this on this series of bonds. We've got a great team. I encourage you to go to the website, learn about the team. Members of our team have worked with clients including Microsoft, Chevron, Exxon, Eventbrite, and Fora Financial. We have Marina Zaharelska. She's our international investment coordinator. She's so smart. She speaks 6 languages. We have Scott Wynn, who's the industry expert for Alamo Mortgage Holdings. He's a veteran of the mortgage note business. We have Fred Hobbs, who's the director of mortgage servicing. He is a licensed mortgage originator, licensed in the state of Texas since the year 2000. And secure net loan servicing is the best. If you need a loan servicing company, if you decide to do this on your own, you want to go with secure net. But I suggest first buy some bonds with Alamo, then learn the note business. David Jones is our in-house counsel. He's a 3rd-generation attorney in the state of Texas. He helps us with all of the legal paperwork, making sure that everything is in compliance. We have Mark DeRuyter, who is our chief technical officer. He's got a lot of experience with developing mortgage software, very talented. Andrew Richings, who's in the United Kingdom, he's a consultant. He's also the founder of Thomas Kelly Holdings, which is a boutique private consultancy firm that focuses on private equity and fixed income bonds for ultra high net worth and high net worth sophisticated investors. So some questions. Why should you buy the notes? Well, if you want an above average rate of return, that's the answer. How long is the term? 3 years, 5 years, all the way up to 50 years, you pick. Can you put the note into your SIP, your self-invested personal pension? That technically is up to your SIP provider, but there's no reason I can see they wouldn't allow it. What type of an investment? This is a corporate income bond, not a government bond. Is it a regulated product? No. And that's part of the reason we can pay so much more than the regulated products. There's an expense involved with going through all of that regulation. And rather than pass that expense on to our bondholders, we are able to pay it out as higher rate of interest. Who can invest? If you're over the age of 18, you're an accredited investor. Maybe you're a trust, a company, a charity. Come one, come all. How's the money protected? We offer multiple layers of security, and we can go through that in a one-on-one call. Are joint applications permitted? Yes. How's the tax managed? We pay all the money to you. We don't deduct anything for taxes. Are there any limits on investment? No, and we welcome larger placements. Can you get access to the money early? No, this is not like day trading, folks, where you read something in the newspaper and you're going to get on the mouse and click and sell at a loss. And frankly, that day trading, it doesn't do anyone any good. They've done studies like 95 or 99% of the ones that try to trade on news, they end up just losing money. How can you invest? It's so simple. Just reach out to us. www.alamomortgageholdings.co.uk and fill out the contact form. We love to hear from new people, or you can call me directly. I've got a US number +1 for the United States, and then 817-203-4160. I hope that helps, and good luck with your investing.